is T, and I'm part of the Vancouver Startup Week team. Before we begin, I would like to take a moment to acknowledge that we are grateful to be virtually gathered on Indigenous land, regardless of where you are joining us from. I'm grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples. I'm privileged to live, work, and play on these lands. First, I'd like to thank everyone for joining us for VSW 2021, and welcome to A Street Fighter's Guide to Raising Capital, hosted by Valhalla Private Capital. This session is also part of the VSW Founder Track and is proudly supported by Sage Accounting. Sage knows you didn't start your business, become an accountant. Sorry to any accountants out there. The Sage Accounting will keep your business organized and running smoothly, track your cash flows, send out invoices, and get paid quickly. So you can visit the Sage Accounting booth to access free guides and templates for starting your business finances the right way. Plus, get an exclusive VSW discount if you're ready to switch from Excel. I would also like to thank Valhalla Private Capital for being our event partner and sponsor. VSW could not happen without the continuous support from our community sponsors. So during the session, if you have any questions for our speakers, please post them in the Q&A on Whova. You can also upvote questions. We'll also have polls in the middle of the presentation. But for now, I'll pass the mic over to Camille and Grant, and we'll get started.
Great, thanks so much, T. And I'm just wondering if everyone can see my screen at the moment. Grant, can you see it? The PowerPoint?
Yeah, I can see it, thank you.
Awesome. Okay, well, welcome to our presentation, everyone. And congratulations, you've made it to the last day of Vancouver Startup Week. And I know that we're probably just an hour between you and going outside, to enjoy the wonderful weather or having a few beverages at least, or if you have them, why don't you bring them? I've got my water here, so, go on, grab yourself a drink, grab yourself a snack, and get set in. We're going to have a fun time. It's just going to be an hour with Grant and I, and we're going to be presenting from our Basecamp material. So just a little bit of context. We at Valhalla Private Capital, we do Basecamps, which are usually 2.5 days spread out over 2 days or over 4 days in evening sessions. And we usually teach investors and entrepreneurs how to think like an investor or vice versa. So this is condensed, so it's 2.5 days of content all into 1 hour. So this is going to be fast and furious, but as a teaser, if you're interested, what we can do is we can provide a discount link, which will be in the chat later on. I can post that in if you are interested into diving more deeply into some of the material, because this will just be a very high level, quick overview of some of the highlights from Basecamps. Basecamps have been delivered Canada-wide and globally. We've delivered them to over 1,200 different entrepreneurs as part of accelerators and incubators in Canada. The content is Canada specific. So feel free to enjoy and take notes. And also, make sure that you go onto the Hoover platform and write down any comments, questions that you might have. There's also the Q&A at the bottom as well. So hit that up if you've got any questions, and we'll try and answer those during our session if we can. So without further ado, what I'll do is I'll pass it over to Grant and he can introduce himself and then we'll continue on from there.
Hi, everybody. A little bit about myself. My journey has been 5 years as an investor, an angel investor. Before that, I was with a number of different startups. And I got to experience, as you can see, the 4 bullet points here. Experience an IPO, selling to 3M and selling to another company called Quest Software in California, and then working for a startup in Sri Lanka and another one in Sweden, and helping out those in BC. So it's been a fun journey. My hats are off to all and everybody that is in the startup seat. You founders have some great, exciting work, but some heavy lifting to do. So we're here to try and provide you some good insights, thoughts, comments, feedback, as well as to try and level the playing field for you. So we really want you to see what it's like to be in an investor's shoes, so you can understand that. Investors are negotiating all the time on deals, whereas a founder, you may do it once or twice, unless you're a repeat founder, and then you've already done it a number of times. So we're trying to level the playing field here with Street Fighter's Guide to Raising Capital. Back over to you, Camille.
Okay, awesome. And a little bit about myself. So I'm the president of Valhalla Angels in Vancouver. my background is in healthcare, so I spent 7 years in the hospitals and private clinics, and I switched over to corporate innovation, and I had a startup in women's health. I'm also an active angel investor and really enjoy SaaS companies, women's health, and companies that can really change the world. So if you are one of those companies, please send me a note. Okay, a little bit about Valhalla. So you might be wondering, who is Valhalla? And I'll keep this really brief, just in case you've been to one of our sessions already before. We have over 140 investors across 6 chapters. So we have Vancouver, Kelowna, Calgary, Edmonton, Regina, and Saskatoon. We're one of the most active angel groups in Canada, consistently in the top 3, according to the NACO, National Angel Association. We also have the top angels of the year from 2018 and 2019 as part of our members. And we also have a couple of other parts to Valhalla Private Capital. So this is the angel space that you are part of. We also have our investor and startup programs, like our base camps, which is what you'll be getting a little bit of information from. So we do base camps for entrepreneurs, and we also do Angel 101 to train angel investors how to become good angels. We also have our third arm, which is our private equity and debt funds, such as Old Kent Road Financial and Asian and LATAM funds. We also have our mergers and acquisitions advisory services. So if you are a company that does come through Valhalla, or if you're interested in exiting, and if you need some advice, need some help, we have some partners here who are able to assist you with that process. And then we also have our global accelerator, where we've delivered some of our content to. So for today, a quick agenda. This is what we'll be going through over the next hour. So we'll start off with a quick poll, which T is going to be loading up pretty soon. It's just a quick yes or no. Then we'll talk about what type of founder are you and why. So just doing a little bit of self-reflection, which will be very short for the 1 hour, but we'll be doing a little bit of thinking about what type of founder are you, because that will depend on what type of capital you take in and what is the best source of capital that you'll need. We'll talk a little bit about an investment thesis, some deal structuring, and so how you can structure your deal the best. We'll talk about some closes and some exits in Canada that have recently occurred over the last couple of years. And then also, what would you do as an investor? So getting you as an entrepreneur into the mindset of an investor and how they think. We'll do a pitch. So Grant will be pitching to us as a startup, and we'll be able to poll the audience and ask you, whether you would invest or not as an angel investor. And then where do you go from here? So a couple of resources and bits and pieces to finish off. Okay, so let's get started. So rich or royalty. So I've titled this slide because it's really important to ask yourself, why are you raising capital? And what's the best for you? Because there's always impacts when you raise capital. So one, you can either take in capital, you can think of it as rocket fuel to progressively grow faster, scale aggressively, and that will make you rich essentially, because you'll be taking in external capital, growth capital, so that you can do these things. And that's great. But then also there's the flip side. If you don't take in capital, then you'll essentially have more control. You won't have stakeholders and shareholders and investors asking you questions about why you're doing things the way you are. So you can either essentially be rich or royalty. And so you need to consider for your company, what is the impact and what is the best choice for you? Because not every company essentially will need to take on growth capital, nor should they. We'll go through a couple of models over the next couple of slides, showing the difference between like a straight line model and a venture or a hockey stick growth model. Essentially, as an investor, we're asking companies, are you investable? So what does that even mean? And as an investor, we're thinking about, okay, what type of returns am I going to get? And that's just one aspect essentially, but from a financial perspective, are you a company that's going to return my money like 2 weeks, or are you going to return it 20x? So thinking about your company in terms of returns is really important, because you need to think, am I delivering a painkiller? So something that is really essential to my customers. So is it something that's really going to change a lot, or is it going to be like vitamin C, like a little supplement? So here is one example of revenue model. So a straight line model here, we've got dollars on the left-hand side, and then we have time on the bottom. And you can see that here, this is an example of where you're investing money over time and you're getting consistent revenues that are going up and up as dollars are invested. So essentially, margins are eaten up by labor, retail space. You need to hire so that you can continue to grow. And it's usually companies, and if you think of this as companies like consulting firms or engineering firms, accounting, doctors' practices, where you invest money in, you get money out, and it's a straight line model. And that's not necessarily a bad thing. I mean, it can be an excellent cash type of business. But then there's also this type of model as well, where you have your dollars coming in, and then there is this point, and you can see it just right here. I don't know if you can see my mouse or not. Where you have this surge in growth, and it's almost like a growth inflection point where all of a sudden dollars in don't equal the same dollars out. It goes dollars in, exponential dollars out. So this is the hockey stick or the venture model that a lot of the investors are looking at. So there are a few types of angels out there. So we've classified it into 5, and I mean, this is not completely exhaustive, but there are 5 different types of angels, and I'll expand on them now. So we have our control freaks who build businesses. So these are the angels that really like to be hands-on. They like to really have an idea of what is going on completely within the whole business. They like to be heavily involved and make sure that they're helping actively, just trying to do as much as they can, essentially, as an angel investor. Grant, do you have anything you want to add to the control freak description?
Yeah, so when you're interviewing for investors, you're trying to understand which of these categories they fit, and then which one would fit the way that you want to go forward. So you may not want, the first one in there, but you may find that, hey, there's people that like to have hands-on, they want to be engaged, and if you can get them their energy in the right spot and fill a gap for you, they may just be perfect. Right. So we have that in our group. We've had one gentleman that became the chairman of the board for a company. He was micromanaging for the year, turned it around, then he stepped back and let them run, and that worked out really well for that company. So just something to keep an eye on and to keep in your mind about what type of person is this, what's their investment style, etc.
Mm-hmm. Yeah, and also a really good point, because some entrepreneurs will be looking for a certain type of investor. So I was speaking to another founder just recently who was looking for a super angel. So this is someone who would typically write a larger check, lead the round, and be someone who can deliver a lot more network and resources to this company. Or you might like someone who is looking for a type of sprinkle and sprout investor. So this is someone who essentially puts in a small check across multiple different types of companies. Smaller sizes typically, so not the 100,000, but they might be writing like a $5, $10, $15, $20,000 check. And they might be doing smaller check sizes across different companies. And it's almost like they're sprinkling their capital and hoping that one of them will sprout up, just like this little plant here. There's also the yield types of investors. So they're just looking for just quarterly dividends. So they're just hoping that they'll be a constant revenue source, as opposed to just looking for a large exit. Because essentially, as a company, you're competing with these types of investment deals. So we have, real estate, which in Vancouver we know is sometimes a little bit higher than the 2 to 4%, but typically this is on average. We also have bonds, public markets, venture funds, and angel investing. And we can see that angel investing actually is quite lucrative, especially in comparison to some of the venture fund portfolios that are coming up. So yeah, on average, typically we see our investment returns of about 23 to 27%. Obviously dependent on your investment style, your thesis, and which companies you invest into. Okay, so moving on to the next section. So what is your investment thesis? Typically, you know, these are the 6 points that you'll need to do to have to convince an angel like why they should invest into your business. So the first is, what's your big idea? The second is traction. So do you have any traction behind your company? And that could be things like sales, customers, letters of intent. If you're a company that doesn't have a product just yet, can you show that you've got like a customer base, or some people in the pipeline that are willing to sign on once you do have things like your regulatory approvals signed off. 3 is, can you protect it? So do you have like an IP moat or a shield around some of the products that you might be having, or do you have any trademarks? Is there anything that you can do so that intellectual property that you can protect it so that someone else can't just necessarily steal your idea from you? Do you have a great team around you? And so this is really important for some investors, as you know, they're really looking to see what type of team is surrounding the company so that they can deliver what they're promising, essentially. The 5th one is the deal. So what are the terms and conditions of the deal? Is it a fair valuation? Does it seem like a really good investment from an investor standpoint? And the 6th is, can you give it back to me? So what does an exit look like? Because we know that a lot of companies want to take their company as far as possible, but essentially there will need to be an exit at some point, whether it's closing or whether it's an acquisition, an IPO, or maybe even a SPAC. And so we'll go into some of the most recent Canadian exits later on in this presentation as well. Brian, I can see you moving around. Is there anything you want to add?
These are the things to think about when you're talking to angels. Obviously, you want to have a means of bringing these up in your pitch deck, regardless of the amount of time that you have. If the format is, hey, you've got 5 minutes, or the format is you got 45 minutes, these are the things to go through. The second one is really what makes you unique. So when Camille was talking about what are you competing with, well, you're competing with other asset classes as investment options, and then you're competing with other startups, right? So you need to understand what's going to resound or resonate with an investor, and how they're going to evaluate these 6 points. And that's pretty critical for you to not only do the raise, but also looking at the type of investor, if you want them involved with you long term. So you can talk about it being smart money. You may have heard that term. So if you're looking for somebody that comes from that industry, can help you move forward to your milestones, is going to be able to pull in customers or attract other talent, or has knowledge on how to work this marketplace or transactions, or knows good suppliers for you. And those are all important things to look at from the traction point of view, and affecting the opinion of the investors that you're talking to. Back to you, Camille.
Okay, awesome. So just thinking about the deal, so I just briefly mentioned something about the valuations. So valuations are really important because an investor needs to understand, like, is this a good deal for me, essentially? And valuations is something that's super hotly talked about within the startup atmosphere and ecosystem. It can be often very difficult to value your company, and so it's really important to have an understanding of what type of valuation method, or I guess reasoning and defense that you're going to use to justify your valuation. There are a couple of methods that you can use. One of them is the Beokhoff method, where you basically assign a bit of company value to each of the points on the left. So if you have a sound idea, you might add this much money, and then you can sum it up to the bottom to give your company a valuation. Now, this is just one method that we use. There are other types of methods as well. So in summary, it is a conversation between you and the investors. If you're unsure, investors will generally try and provide you with a fair valuation. So if you're completely out to lunch, they'll tell you why. And if you need some assistance or any help with helping you do your company valuation, then the base camps are an awesome opportunity to really dig into some reasons as to how you can defend your valuation as well. Okay, so this is a lot of text on the screen. I don't expect you to read this at all, but this is one of the Valhalla Private Capital's partners' investment thesis. So you can see that she's got 10 points here that she really considers when she invests into a company. And essentially you can see that it's an interview on both sides of the table. So the investor is interviewing the company, and the company is also interviewing the investor as well to determine, okay, like, is there a good fit? Essentially, the company is saying, okay, what type of angel are you? Are you a control freak? Are you a super angel? Are you someone who sprinkles and sprouts? And really trying to understand, is there a good fit? Because investment is a long-term relationship, and you want to make sure that you have the right people on board with your round. So yeah, this is one of her investment. This is her investment thesis, and I thought I'd just post it up because this is a really good insight into how some of our partners think.
So this is a good one, Camille, as well, to allow for you as founders to generate some questions for people. You like to invest. What industries? How do you invest? When was the last time you invested in that industry? What are your expectations? What do you look for inside for traction, the team, etc. So I've seen other founders say, I like to invest within a 2-hour radius so that I can drive to go and see the companies and the founders. So you're going to get all sorts of different responses, and it's important just for you to have that opportunity to investigate that and feel, is it a good fit? Is it really somebody that I'm going to do this with? Because essentially you're going on a journey for the next 5 to 7 years with this person, and they may be asking you questions on a regular basis, or they may be offering up support on a regular basis. So if you're all going to be in the same boat going there, you want to be able to, as it says in the point 10, I have to like the founders. So it's a good thing that you want to also like the investors and feel that there's some value that they're going to bring to the table other than just cash.
Excellent. Okay, so yeah, this is over to you, Grant. So
definitely. So feel free to ask questions throughout this. Post them. I know you can't actually get on the audio here, which I'd love to be able to answer that way. But go back, Camille.
Sorry.
It's kind of stuck there. Okay, there we go. So these are obviously, as you can read, the types of funding sources that you can get. And there's multiple ones here. There's, of course, yourself, your family, your friends, the banks. The banks being early stage where you may be taking off a secure loan against some asset that you or maybe your parents have. You're maxing out your credit cards perhaps as well. And the grants are important from a investor's point of view, is to see how you were able to raise non-dilutive capital. So that's one other area that people do look at. Of course, the crowdfunding. So we've got Front Funder in Vancouver. We've all seen Kickstart and Indiegogo. And then there's different ways that accelerators operate. So you need to understand, if you're going to apply for accelerator, what is the purpose of doing that? Is it to get a little bit of the cash, to get that education, to be saying, hey, I made it in the Amazon accelerator, I was in the Google accelerator, or whatever the right industry is for you. Then there's angels groups and large family offices. So you can think of the family offices as people that have had money being passed down generation to generation, or their new money, of course, and now it's the family that's making the investments and making decisions going forward. You've got professionals that will do that, and we'll get into a little bit of hierarchy of what we see as the value of different cash coming from different sources. And keep in mind the implications here. So that last bullet across the top of the title, each one of these sources of funding have different implications on how you are expected to act, as well as what they're expecting to see. So if it's from family and friends, that's an important check mark for us as investors. We like to see, oh, so you can get any of your family and friends to invest. So why would we invest as well? On the flip side, for you, you might, if I'm going to do this with family and friends, and I've got my mother into it, she really supports me, my dad too, brothers, sisters, aunts, uncles. And if something goes south, then you have to have those family interactions, Christmas and New Year's and birthday parties and anniversaries that may be a little bit sticky. So you need to figure out what the implications are of that. The VCs have the funds and VCs have very strict economics that they're trying to follow. And you need to be aware of what those economics are and how it's going to affect your decision making and what pressures are going to be put upon you because of their economics and their requirements. So we'll go on to the next slide here. A little bit more about, you've got the early sources, but what's that deal structure going to look like? And what does it mean in your minds? Has anybody got a question around some of these deal structures? There's, of course, debt. So it's a convertible note or just strictly loans. We're seeing a lot more venture debt. That marketplace is really taken off. So loaning against your revenue streams or just loaning against your future credits. So that could be venture debt against a shred. So if you're doing research and development, you've got a check coming from the government, but you don't want to wait 5, 4, 6 months. And then you're going to go and take a loan for venture debt. Of course, convertible notes are an important player. I'd say pre-COVID, we were probably seeing 75, 80% was equity being sold as an investment option, and 20% convertible notes, and then 1 or 2 safes here or there. And now it's probably more about 25, 30% convertible notes, a little bit less than the equity, and we're seeing a few more safes. Haven't seen any kisses, and the structured exits are I'm not seeing, those are very infrequent. So these are some of the deal structures, but you need to know the details of each of them. So let's take a convertible note, for example. Are you offering up, what's the term? Is it 2 years? What's the interest rate? How does that interest rate compare to somebody going out on that slide that Camille had up earlier, right? You're competing with these sources of returns from different areas. So how do you make it interesting for investors to say, yes, I'll put that money in? By way of example, I've got a venture debt. So this is my farthest away investment in South Sudan. They're paying 36% interest, but if they go to the bank, the interest rate at the bank is over 50%. So even though I feel like, oh geez, I'm gouging, and then they said, no, you're not gouging. You're giving us a huge break. And I said, really? Like this is a big break for you? I said, yes, and I'm not giving you any equity in my company either. So they felt it was really reasonable and allows them to operate. Whereas I thought, oh, that's way too high, that interest rate, but not compared to their local market. So they were aware what their local market was, and they were aware of what we up here in Canada see as interest rates, and they took advantage of that differential. So in your convertible note, coming back to that a little bit, you need to understand what's the interest rate you're going to pay, what's the term, when does it convert? Are you the ones deciding it converts, or is the investor deciding when it converts? And the interest being earned, is that part of the conversion, or are you paying out a monthly or quarterly check to them? So there's lots of decisions and negotiations that can go on just on a convertible note as well. Camille? Thanks. So we talked a little bit some of the deal structure here. So there's also what's capped. So we see very often with the safe, you're going to have a choice between the next round. Does everybody know what a safe is? I don't want to. Yes, no. You want to throw it in the chat? Who knows what a safe is? What's the acronym mean? Anybody?
Has anyone wrote anything in the chat? I can't unfortunately see it because I'm presenting.
Oh,
okay.
I can see it. I see a comment that asked your thoughts on safe, but otherwise nothing about the term.
Okay, so the safe is a definition that was invented out of Founders Institute. Founders Institute. I cannot remember the gentleman's name. It's a unusual name like AEO or ADO. He and his group invented this. His roommate was Elon Musk by chance, so maybe it came a little bit influence there. And then Y Combinator in the US picked it up and asked if they could use it. And they've popularized it. It means simple agreement for future equity. So it's a cross between a note and stock, but you're either of those. And it was when the negotiation power is all in the hands of the founders. So in other words, the founders, you guys have a hot company that everybody wants in, and you say, here's my safe. It's simpler to use. It's only a couple of pages. There's not a lot of legalese involved with this. And that was part of the desire to have something really simple, so you're not getting bogged up with legal terms. But it didn't give the investor, they didn't know which were they, equity or debt. And then once the next round of your next raise comes around, then the price of that safe round gets priced out. So you're actually waiting for that round to happen in order to get it priced out. I'm in a safe right now that I'm still waiting 4 or 5 years now. I've lost track for the next round to happen. And they haven't happened. It hasn't happened whatsoever. So it's very frustrating. I have basically no rights. I'm not equity. I'm not debt. I'm not in the exit if there's an exit right away. So we're trying to negotiate right now with the new CEO as to converting over the safe money that we put in and putting it into equity. So this is an uncomfortable experience. So for me, safes are not ideal, right? Unless I have really good faith that the founder is actually going to do that next round in the 6-12 months coming up. So we're seeing now terms to get around that. So typically in Canada, we're not seeing a ton of safes because it is originated in the US, but we're seeing safes with terms that make it look more like a convertible note. So it's not a pure safe, but they're still calling it a safe. So we could really call it a convertible note, and it would still fall under the terms of a convertible note. So when you're talking to people about a safe, you need to make sure that they understand if it's a pure safe, that you're not equity, you're not debt. And yes, I do have another round, which is going to price it out. And that way they know that they're going to get some value for those shares and they'll be converted into shares. Does that help, Ramin? I know you posted the question. Okay, thanks. You're welcome. When you get into these other parts, so we talked about a little bit of the cap. So a safe could have a cap on it, or could be a discount off that based on what the next round is. Liquidation preferences, we typically see that when a VC comes in because they want to take a little bit more on their risk. They're typically throwing in more money. And they said, hey, we're going to now put ourselves in front of everybody else that's invested, and we're also asking, requesting, and demanding that we have a preference 2 to 1. So before anybody else gets any money, we're getting twice our money back immediately. And then we participate with the rest of the investors at the same level as everybody else. So you can see that. What that means for an angel is that we want to have the right to invest again at whatever the conditions are for the next round. So if you get a VC coming in and they're saying, hey, we want 2 to 1 preferences, well, I get to buy in at that round at the same rate. The class of shares, you'll notice a difference between Canada and the US. In the US, they talk preferred shares all the time. In Canada, we talk about common shares all the time. So there's a difference across the border between those, just so that you're aware of that. And the main thing is alignment. So when we're in that boat traveling, for the next 5-7 years together, I want to be in the same class of shares as you, as the founders. And that's so that there's complete alignment going forward. Evaluation, for certainly it does matter. We just had the Angel of the Year give a presentation on how he's doing his investment. He happens to have a family office, and that's the first thing. So out of all the whole Beokhoff method, the first thing he looks at is valuation. Because if he's looking for a 10x and you're already priced really, really high, he's going, oh, is this team in the market going to allow for 10 times that return? And if it's not, he's not in. So it does matter. And then, of course, what I talked about there, the right of first refusal or follow on, that comes back a little bit to the example of the liquidation preferences. So I think those are some of the term deal structure, but very much your deal structure is an important aspect of what you're pitching, right? It's critical that you understand this, you understand the variations, the impact of this on your business, and the pluses and minuses of each of them. Camille, please go forward. All right, this seems to be a tough one for a lot of folks to get what an exit is. And I mean that from the point of view of actually doing the research and showing it on your slide. As so here's our logical path to having that exit and what that means to give back to the investors, as well as yourself and your friends and family that have been hanging around for a long time. And how long will that take? So we see a lot of deals. We get about 1,500 requests a year to pitch to Valhalla. And then we have effectively 50 slots for people to do that. Right, so we get about 350 that apply out of that 1,500 that we talk to. We say, hey, you're a good fit. Please apply, come through the deal screening, and then 50 get into the deals, get into the right to pitch in front of our investors. So and we still see the exit slide as a last afterthought. So you're either, well, I won't get into where you're going to exit, but I'll describe that in the next slide. But how long? 3 years, 5 years, 7 years? Does anybody know what a investor is referring to when he talks about a zombie? You can go to the chat and just put down your thoughts on what is a zombie? Not from the movies, though.
I would also say that with exits, I mean, like this is something really important for us, but as an entrepreneur, it's something that wasn't really discussed a whole lot in communities, I don't think, about like, you know, because I mean, I guess the initial thoughts are that, you know, you want to focus on developing a really fast growing company. So there wasn't a lot of good quality content on how to exit and what that would look like. So yeah, you know, we do get a lot of companies coming through Valhalla deal screening, and often this slide is somewhat underdeveloped. So if you can paint a really clear picture, and of course, you know, an exit is never clear, but, you know, if you can paint this picture of what it would look like potentially, that can really help an investor make that decision whether they're in or not. So yeah, have a really good think about this.
So to answer the zombie question, it's a company that is neither going to have an exit, because there's nothing coming down the pipe that's showing that, or they turn themselves into a lifestyle company, which is that straight line graph that Camille showed earlier, but they haven't died either. So they've captured the money of the investor and they're not giving it back anytime soon, or maybe never. But the investor doesn't have the right to also have a tax write-off for that money not coming back, because the company has not, you know, gone into receivership or anything like that. So that's a zombie. They're neither alive, they're not dead. Camille, please go forward. That'd be great. So here's a very important graph or chart. Camille's pulled this together to reflect what are some of the biggest exits. And if you look under the acquire or /IPO, you can see that there's a number of companies that have been making purchases. So if you come to us and say, hey, Amazon's going to buy us or Google's going to buy us, you know, we can look at the information and go, Google hasn't bought in that space in a long time, right? Or Amazon hasn't bought in that space in a long time. And take a look at the age of these. We go back down to 2007. So here's the top 25 since 2007. And how many were IPOs? We've got 5 in there. So 5 out of 25. Right, so when companies come to us and say we're going to do an IPO, we go, well, this chart's showing 5%, right? And it's typically less than that. It's typically 2 or 3%. And then we do have a SPAC in here. So if you don't know what a SPAC is, you know, go take a quick type into Google and ask look what a SPAC is. They're a US reverse takeover type or a CPC type of activity in the US. The point here is a couple things. we understand as investors who's doing the acquisitions typically, what's some of the valuations that are happening out there, and what's the frequency of them in Canada. So if you also take a look at this and you see announcements, you know, Wattpad, number 9 there, 600 million sold to Naver. That sounds amazing. How much of that 600 million, which is never shown in these press releases, got into the pockets of the founders? And we'll go through an exit waterfall in a minute here, but that's really something that you need to understand what this journey is going to be like for you and where it can take you. And so you're not being disappointed and going into this with your eyes closed. Very important point.
Yeah, and these are also the top Canadian exits as well. So, you know, this is just like a really good sort of like, I guess, like estimate for like, you know, how much is a Canadian company, because, you know, this is Vancouver Startup Week. How much is your company going to go for? And, you know, like these are the best 25 in Canada. So, you know, what does an average exit look like as well? So that's something to keep in mind, especially when you start with your valuations for your first round or your angels round. You know, if we're thinking about our multiples, then we need to also think, what's it likely to become, you know, one of the top 25 or the top 10 in Canada? Like, what is an exit size going to look like?
Yeah.
Oh,
so let's match the cost of your fees with this pyramid here. We rank them A+ down to F, and this is all depends. You can go out and find exceptions all the time. So on the left-hand side, the type of investor, the ranking. So super angels are local mafia in the city. So a local mafia, friendly term that we're using here in Vancouver, would be Pattison, Jim Pattison, right? You want to go try and get an introduction to Jim Pattison, the self-made billionaire. How are you going to do that? Look at the research, do some research on that person and find out how that person invests. Then there could be people that have just had an exit, you know, rich business owners. So all those people that were just on the previous list, you may be able to approach them and go, hey, you just sold for 600 million. Are you looking to make investments? Then you've got the angel groups like ourselves. There's demo days. There's all sorts of accelerators out there. Then you're going down to the B's and the C's, where there's starting to be more pay to play, more fees coming up. They can also be very successful for you. We just don't consider them to be highly what's the word, desirable at this stage when you're doing your early stage. You may be forced into, you know, going public earlier than you think by going with brokers, because that's how they get compensated. So look for the underlying motivations. They can be very helpful though as well. And the penny stocks, you know, we were saying that walk away from those. And crowdfunding, the only reason we have crowdfunding so low is because there's no opportunity to have smart money in there, right? Everybody's got the rules in which how much they can invest into that startup, and that's it. They can't affect it. In fact, the investors have to sign typically proxies, which don't allow them to even vote and help you move forward. So that's an important structure here for you to understand the types of investment opportunities or types of investors out there. Okay, so this next part is, you know, we'd love for you to participate. So what we're going to do is I'm going to now pitch a company to you. Then we'll have a poll come up, and the next slide is those 6 points, I believe. So you want to look at this and come up with your thoughts on, would you invest in this company? So I'm going to do about a 3-minute pitch, and then if you like to ask questions in the chat, feel free to do so. Hi everybody, my company is Your Media Eye. We deliver the right advertising on display screens in elevators and high-end residential and commercial towers. These are ads that are very targeted based on who is in the elevator. So when the ads are not running though, we provide public service announcements, news, building updates from the building property manager. So our model is to install our product free of charge for the building owner and provide them with 10% of the advertising revenue. So our product consists of a screen, a small CPU, connectivity back to our servers, and then a camera to identify the demographics of who the elevator passengers are, and facial tracking to gauge their reaction. So we can actually see when they're looking and when their attention is there. This really allows for some A/B testing. So I can try one ad on one elevator, try another ad on another elevator, see what the reactions are, and then decide which advertisement to go forward with. So for instance, if a group of young women get in the elevator, the ad will reflect that demographic, which may be, clothing or makeup, versus a group of young men get in the elevator, and that ad may reflect, sports or trucks, because we're not going to run a makeup ad for guys getting in the elevator. It just won't be effective for the advertising company. We already have 2 patents in place for that technology. We've got $300K raised from family and friends and some non-dilutive from IRAP. And there's 5 of us on the team, myself, a couple of engineers, a salesperson, a customer service rep. We're in discussions with 5 large property managers with 1 LOI, letter of intent in place. Between their buildings, which is in Vancouver and Toronto, they have over 850 elevators. And we expect to close the first one in June. And we do a 5-year contract. So they understand we're putting in hardware, we're taking installation time, and that this is a long-term relationship. Our revenue is about $3,000 per display in the elevator per month for up to 20 ads. So it'll be $3,600 a year per elevator. We do have a few competitors out there, but none of them have the patents for that demographic recognition, nor the ability to say what the passengers in the elevator were looking at in facial recognition. We're looking to raise $500K at a $4 million pre-valuation, pre-money. It's a convertible note. It's paying 15%, and the interest gets converted to shares in 2 years. So it's a 2-year term. Our goal is to grow big enough that one of those 4 competitors are going to be so angry with us. The main one is Captive Networks, and they've got 12,000 screens in the US already in elevators, but they have no facial measurement, no technology, and to them to do a retrofit would be just hugely expensive. So that could be one of our exit strategies. Thank you very much. I hope you take time to ask questions and look at investing with my company here and our team. So that would be it. Ty, could you put up the poll for that? Would you mind? And ask any questions, anybody?
So the poll is up.
Sorry, it's a poll about would you invest or not.
We're just waiting for responses to come in. But I have a question about the pitch. So how much time, since you have limited time, how much time should you be spending on, for example, each section? Like the team and how you protect it, the exit strategy?
Good question. So we actually have a recommendation on that specifically for a 3-minute pitch and a 10-minute pitch. It's a guideline. We will gladly share that out with whoever like that. We can, send us an email, or I'm not sure how we can capture the names here, but we'll gladly share that out with you. The one caveat in that is that second point, traction. So if you have an amazing team that's had exits already, they've raised capital, they've been very successful, then you'd spend more time on the team. If your advisory and group and the first investor was, Elon Musk, Bill Gates, some big name marquee, then you'd spend more time on, here's our advisory, here's our investors, here's why they believe in us, so that you can create that sense of traction and progress. So we'll gladly spend that out to you. The key is, though, not to spend a ton of time necessarily on the product, because it's going to be more on what's the deal structure, what's the opportunity, and how do you give it back to me. Those are key. So when you send in somebody to give a presentation, know who your audience is and send the right persons, because we've had it such that the CEO had to swap out at the last moment. They sent the CTO in, and all we heard was product, acronym, product, acronym. And it didn't go very well. It just went over people's head. I don't understand that acronym. What the heck is he talking about, or she talking about? So, understand your audience and then provide the right type of content for that. Does that help?
Yes, thanks for answering my question.
You're welcome. So let's move on to the next one. I'm not sure how the poll is coming along. I can't tell. So this would be the other part of it. If you're stepping now, you've seen the pitch. What would you invest? And two, how would you invest? Are you going to put a little bit of money in? Are you going to take a big chunk of that round? What type of role would you like to play? I'll give you my examples. I'm typically keeping my eye out every time for any company that I've invested in for opportunities, and I'll pass it along to them. So, have you talked to this person? Did you see this piece of news? Here's an introduction I can make. So I fit between the super angel and the sprinkle and sprout, but I'm not in there to control whatsoever. I want to help them along, and if they want to call me for assistance, I'll gladly do that. Gladly take those calls. And that's after I've analyzed, would I take their call Sunday night at midnight because they're in trouble? So if I can't answer yes to that, then I'm not investing in that company. Okay, Camille. The exit waterfall. So going back to that slide that we saw, all those big dollar signs going against those companies, the IPOs, the buyouts. Again, it doesn't show you what the founders are getting. So these are the people being paid out before the equity, which is where the founders sit. So you're at the bottom of the exit waterfall. So you've got all the legal and taxes up front. If you've got any debt, we know that debt's paid early before venture capital, before equity, all the way down to, in the equity spot could be your friends, your family, yourself, the angel groups, etc. So this is important to understand. And on the next slide, here's an example of what that waterfall could be. So announcement in the paper, so you're sold for $100 million. You've done 3 rounds of financing, which leaves you with, on that bottom right, for founder 1 and founder 2, that's F1 and F2. There's 2 founders. You've each ended up with 21%. The angels have ended up with 18.9%. And the VCs have come in and said, we put in 5 million and 10 million, but we've also asked for liquidation preferences of 2x. So out of the 100 million, they're getting 20 million respectively in the brackets, and then 10 million. So they've already taken 30 million off of the top before it gets down to equity. So this is what you need to look at from your exit waterfall. And we've had exit waterfalls where we're getting 0 and the founders are getting 0, or they're getting 8% of all their 10, 15 years of work, and they're not getting a very good return whatsoever. We recently had the founder of Ancestry.com approach us, and that was in November, and he told us a terrible story, years of hard work, of getting Ancestry.com up and going, and the VCs took all the money. They made out like bandits. I'm not trying to paint VCs in a negative light, but because of that, his return was peanuts. His next company that they started up, he's not going to any VCs. He's staying away from Boston, New York, and Silicon Valley. He's approaching groups like Valhalla to go and get friendly money and patient capital. So very interesting that he's done that. So, the Ancestry.com got sold for $4.7 billion. His annual return was 8% on his time and effort, which is nothing. So the VCs again made out like bandits, and he walked away with almost nothing. So, good experience to understand. Terrible story for him, but he's all on to his next startup and doing well. And here's the dilution. It's assuming that every round you're being diluted by about 25%. So you can see you're at 50-50 to start with 2 founders, F1 and F2, and this brings us down by round 3, you're down to 21%. So you start at 50%, you went down to 21. Why do we show 3 rounds? Because that's the most common spot in Canadian high tech that the companies get sold. And what's the average for that? It's 30 million. So 2 key important pieces of information for you. There are exceptions all the time, but if you get coming in and say, we're going to sell for $100 million in 5 years, and you have your capital plan, you're going to do multiple rounds. We know on average it's about the third round, and it's about 30 million Canadian. So the other aspect of this is to decide, coming back to your royalty, or you want to be rich, how much are you going to dilute yourself, and what level are you comfortable at dilution? At what point do you go, okay, that's enough, I'm no longer interested in doing this? So we've had companies come through, very mature founders say, hey, this is my second go at this, totally understand it. I'm willing to go down to 15% dilution. I have no problems with it, and here's how it's going to go. I'm going to get to the 4th round, and I'll be at 15%, and we'll be skyrocketing. And that was very, very unique to see, because we do not see capital budget plans from founders necessarily all the time, which you want to work out that map and figure out what that's going to look like for you. So our last thoughts here are some recommendations. Think of the research you're doing on target investors. One ideal investor is as much time and effort as you're doing around product development and product market fit. So when we ask, we had a panel on this earlier this week. We had 4 different companies in there. We asked the founders, how much time did it take to raise capital? And they were all saying, oh, it was like a task. We didn't realize that this task was going to be 80 to 90% of my waking hours. So keep that, top of mind. Okay, this is a long time effort. So that dictates a little bit about target investors, who, how, and how much do you want from them? What's your runway? What's your burn rate? Of course, you want to be able to present your valuation very convincingly with high integrity and good data. So comparables and competition, and we'll show you a list of resources on the next slide for that. And then get familiar with the financial terms. So coming back to the deal structures and the implications, there's all sorts of research. You can use investopedia.com and easily find lots of terms and good descriptions out there. When you go to the investors, one approach is to ask for advice. What do you think about this? Is this the right market? Am I doing this correctly? Is this a good solution? We're trying to solve this problem. And they'll, if they're a good fit for you, they'll take an active interest, and then they go, hey, maybe I should invest in this company. So start off asking for advice, and then versus asking for money up front. Lots of networking events, the Vancouver Startup Week, there's all sorts of them out there. Just do a hunt for that and start to do it in advance of asking for the capital. Start that networking out there. We do offer Founders Basecamp, which is a good, as Camille said, we're trying to jam a 2.5-day course into 1 hour here. But the Founders Basecamp ends up with all the founders actually keeping in touch with each other. So it becomes a network of other founders, which is really cool how they're helping them out. And as well, being a founder at the top can become pretty lonely. Who do you go to? Well, you can't go to your employees necessarily asking for these opinions, because they're expecting you to lead. The other things I would suggest are taking these things at the bottom. If you haven't taken the course, go and do some of these. Take some free public speaking with Toastmasters. Take an introductory course to business if you're not in business, or the law courses. I would really strongly recommend taking a sales course, because you're always trying to convince people of your ideas. So you don't have to necessarily be selling a product. It could be talking to internal staff, external suppliers, stakeholders, customers. The sales course is really going to help you structure that and think through. It's almost like a psychology 101 course, but there's very good processes in there that you can learn from. And then start to talk to hundreds of prospects. Don't be the field of dreams of build it and they will come. do the flip side and talk to lots of people and go, oh, okay, I think we've got the problem solved. And then start to build it and start to do some code. We've seen, I've been in companies where we we rewrote the reporting engine 3 times. And each time it was about 5 person-years worth of effort. And I couldn't believe it when we did it the second time. And the third time just blew me away that the developers were so far off on, oh, we didn't get it right the second time. You spent 5 salaries on that? That's a lot of money we blew out the window. So take it very seriously on looking at how to develop the right code at the right time if you are doing coding or if you're doing hardware.